first of all, welcome everyone who joined us this evening. And thank you so much for trusting us in organizing finance for ops. I'm really hoping that you're going to learn quite a lot of new things in the session. My name is Oshtrina, and I'm one of the co-founders of Operations Nation, alongside with Astrid and Charlene here on this call as well. And we're super excited to bring you the third event in the series of Finance for Ops. And I'm just going to introduce Operations Nation really quickly. We launched it last month with the intention to have it as a platform that is built by operations people for operations people. A lot of you, just like me, are Jacks and Jills of all trades, and we learn how to be the best operations people that we can as we go in our careers. And with Operations Nation, we wanted to make it easier for everyone to access more all the operations related knowledge and resources, and also to shine a light on all the operations people as well as the discipline, because I personally think that is super interesting. It has so many different faces. We wear so many different hats, and it is never boring. And surprise, finance is one of the hats that we have to wear. And as an operations person, I guess sooner or later you will inevitably end up being responsible for finance. And dare I say, when it happened to me, it was a little daunting, because I'm fine learning things as I go, but not when it comes to finance, because I really don't want to make mistakes in miscalculating companies' runway, or making a mess out of a cash flow, or doing something so that we're not able to raise another round of funding because of whatever investors are looking for we don't have. But I'm pretty sure that Julie is going to go a little bit more into what investors want when it comes to fundraising, and introduce us to the financial planning ins and outs. Finally, I'm here to talk about QUANTICO, who's our event and content partner. And Vern is the founder and Chief Operating Officer of a company called QUANTICO, which delivers world-class finance teams for rapidly scaling startups and scale-ups. And we're very happy to have found a perfect event and content partner, because Juvern is not only a finance professional, but she also is an operations professional. So it's really great that she understands both sides of the equation. And and for this particular event this evening, we couldn't be happier to have Julie Oey, who is scaling finance and operations as a finance director at WeGift, and who also previously built the finance team at Monzo Bank from scratch. And we are also joined by Mark Yates, finance director at Permutive, and Mark will be sharing some of his best practices with us towards the end of the event. And just one more thing before we start. I'm sure that everyone is used to Zoom by now, and you know how it works, but a few things to note is that you can use the Q&A function to ask all your questions, and we're going to gather them in one place for the Q&A session at the end, but please submit them as we go. You don't need to wait until the end. And you can also comment your question or upvote other people's questions, so that we can answer them all in the last hour of the event. And also you can use the chat function to say hi to us and to each other and talk. So yeah, Julie, I will give it over to you.
Yes, I'm Julie. I'm the finance director at WeGift. So my background is mostly in financial services in the last 7 years or so in fintech. So I've been in London about 3 years now, so 2 years at Monzo Bank. I was number 3 on the finance team, and we grew to almost 40 when I left. And so then I joined WeGift. We are about Series A level. So I just wanted to go much earlier into the life cycle stages, get into a smaller company. It's the smallest one I've been in, actually. So I'm actually looking after some ops elements as well. So I've definitely thrown questions at ops stories along the way. So I've been there at 4 months, really enjoying it, and glad to share a little bit of what I know. And Mark also obviously will be sharing some of his best practices later as well. So cool. I'll just kick off. As you know, what we're covering today, we'll be talking about budgets and forecasts under the management reporting as well, and then getting a really high level overview around fundraising, obviously with a focus on how finance interacts with all of these. Just before I start, I did want to emphasize as well, like the things that we'll be talking about, depending on where you are in your company stage, for example, if you're seed, pre-revenue, Series A, Series B, obviously all these things will evolve as your company matures. So it's completely okay to have very rough and ready versions if you're just starting out as a company. And then obviously things will start to formalize as you get into Series A, and then you'll need to start getting more robust as you hit Series B onwards in terms of the data and your calculations and the reports you put together. So if anyone's in very early stages, I'm probably going to be talking about things that are a little bit more formal or structured than you would really need, but hopefully it just gives you a good idea of what to aim for as your company matures. So the meat, budgets and forecasts. Before we start again, the only thing that's ever 100% accurate about forecasts is that they're never 100% accurate, right? So you can't really tell the future exactly, but you can try. And so why do we have financial planning, budgets and forecasts, right? First of all, your projections are the numbers that are really based off your business plan, and they're there to show where you think you will go in terms of your revenue and your expenses based on what your company goals are. But why do we have them, especially if you don't expect them to be accurate? The budgets are a really good way of showing the robustness of your company planning process and your understanding of the market. It helps align between stakeholders, so internal executive members, your board, your investors, your future investors. It really helps to ground and quantify where you think your company is going. And lastly, it provides a really good baseline and some data for which you can measure company performance against. And I'll get into this stuff a little bit more. But just to quickly cover the difference between a budget and forecast, because I know often these words are used interchangeably. So a budget is really the one financial plan that you put together at the start or even before of your year starts. So you're looking towards your 12-month company plan, you're putting that into numbers essentially, and it's something that you'll put together before the year really kicks off. So by that nature, it's usually an annual budget that you would put together. And it gives you a really clear, explicit agreement between, well, within the company and your board about what your revenue goals are and what your spending constraints might be for the year. A forecast, on the other hand, is something that you'll work on as you go through the year. So typically, again, things will never really happen the way you plan them exactly. So your forecast is a good way to incorporate all the things that you're learning throughout the year. And if things change, you can incorporate that into your forecast. For that reason, typically you might do them either monthly or quarterly, just depends on your capacity and what your business needs are. And the idea really is to incorporate the changes and learnings that you come across. Cool. So in terms of structure, you'll typically see these three things in your budgets or your forecast. So your income statement, which is your P&L, it's all accounting based, what your revenue and expenses are. Your balance sheet, which again is a very accounting concept, but essentially the assets, which are all the things you own, your liabilities, so anything you owe to another party, and then your equity, so whatever is left over, which is the company ownership. And lastly, your cash flow statement. So this is the main one, which particularly if you're in an early stage company with finite business cash balances, your cash flow statement is something that should really reflect literally what is coming in and out of your bank account at any week or any month coming up. So it's not accounting based, it really is, what your bank balances will be. And it's one of the reasons why for early stage companies, cash flows statements are just really important to keep track of and monitor closely. Cool. Now, in terms of the process for putting budgets together, this is relatively high level, but the way that I like to think about it when budgeting with the companies that I've worked at, first of all, you start off with your business plan. So, especially if you're an early stage company, you don't necessarily have a formal written out business plan, and that's okay. But ultimately, at least you should come together, with your management team, with your board, and figure out where you want to go for the next 12 months, right? Like you'll still have some goals that your company wants to achieve for the year. So that could be, attracting double the number of customers. You might want to get your revenue up 3x, or you're planning to roll out a new product at scale, enter a new market, anything like that. So if you think about what are the main goals your company wants to achieve, those will really be the foundation of your budget, because your budget ultimately should reflect what your business plan is. Once you as a company have identified what your key goals are for the year, then you can start thinking about what the drivers are behind that. So just as an example, if you are planning to double customer growth, then thinking, okay, what will actually drive that customer growth? Is it, refer a friend campaigns, increased advertising? What does the marketing funnel look like that has to work in order for us to hit those customer numbers? So again, it's, the early stage you are, the more sort of nascent the process can be. But as you kind of mature and understand your business better, like understanding the drivers behind your main goals gets more important, and then reflecting those drivers in the model so that you can kind of show the funnel of how you're going to achieve the goal is something that investors like to understand as well, because really what you're showing is how you plan to achieve your goals, and how robust you are about how you can actually get there. So once you understand where you're going, how you'll get there, then you can start thinking about what are the people and the other resources you need to achieve that. So I'm guessing for a lot of companies that are here, probably people are your biggest expense. So thinking about who you have in the company today, what additional skills or functions do you need to hire for? What level of people do you need? So like adding all of that information in. And then in terms of resources, it could be anything from, like legal, consulting, third parties. Your typical things will be on overhead, will be things like your office costs and so forth. So really thinking about what are all the costs or anything that you need to pay for that you'll need in order for your company to achieve its goals. And then again, adding all of those in. Number 4, considering any external forces, so particularly relevant this year with COVID and the lockdown, but thinking about what's happening in the economy, like again, depending what your business is, are there things happening with the political environment, overseas markets, domestic markets, how will those impact the growth that you're thinking about? And again, also your competitive industry. So, who are your competitors? Are there things that you need to know about that's happening with them? And what are the risks and opportunities that you might have? And if any of them might impact your company quantitatively, then again, building that into the model so you can show that you've been thinking about these factors. And then finally, once you pull all of this stuff together, it'll be quite important to really understand what your P&L and cash position is. And I say this because typically with an investor, they'll obviously be most interested in your P&L. And if you're starting to get into revenue, what your revenue growth, revenue traction will be, and then what are all the costs that you're going to incur in order to achieve those revenues. And then the cash position, just for yourselves as a company, again, it's just like knowing what's in your own personal bank account, right? So, how much cash does the company have today? Once you've, spent all the money that you need in order to hit your revenue goals, will you be hitting your revenue goals, and therefore what will your cash be at the end? Like, this will help you understand if you run into the risk of getting low in your cash balances, do you need to kick off any kind of and start talking to any banks or other financial institutions in order to make sure that you have enough cash to keep the company going. So forecasts. Again, as a startup, things change pretty much every day. So the reality is that your budget very likely could become out of date the day after you put it together. So in order to manage against this, finance teams usually put together forecasts. And again, depending on your capacity and your business, you can do these either monthly or quarterly. But ultimately what you're looking at is incorporating anything that you've seen change during the year. So, if some experiments that you're betting on to drive that revenue aren't working out quite the way you planned, do you have to reproject your revenue, bring it down, or other experiments that you've got going on that you feel really comfortable you'll still achieve your revenue goals? And then on the flip side, on your expenses, again, like if things are changing, if you've been hiring more than you planned, hiring less than you planned, just adjusting those in your plan so that together you can have a look at what is your adjusted revenue, what are your adjusted expenses, and therefore are you still roughly on track for what you think will happen at the end of the year? Cool. Okay. And then just as a tactical point, I've had a question come up quite a lot in terms of how far into the future should we look. And so most models you'll see will be between 3 to 5 years out. To be fair, it's really only year one that matters deeply, because that's, I mean, again, as a startup, you can only look forward so much. So year one is really to reflect, you know, how deeply you're thinking about your business and how much you understand what's going on in the market, and being able to reflect that in your financial model. And then years 2 onwards, they're really more indicative. So typically internally as a company, we don't really look at year 2 onwards, except to give us sort of rough guideposts on how ambitious we want the company to be. The reasons why investors will typically look at year 2 onwards is to really understand the trajectory that you're aiming for. And again, it's really about demonstrating the robustness of your thought process. So if you say that you're going to, you know, grow revenues 10x year on year for 3 years straight or 5 years straight, investors are really going to dig into why you think that, why is that realistic, you know, how you're going to make that happen. So year 2 onwards is really more indicative, and, you know, for the sake of conversation, to dig into how you think about the business, as opposed to anyone expecting those exact numbers to come true. Cool. So one of the final points I want to make about financial planning is my background is more on the commercial side. So I work closely with the non-finance teams typically. And I feel it's really important to always stay really aligned with everybody. So that includes your internal stakeholders, so team leads from other areas that contribute to your budget. So it could be sales, marketing, or, you know, any other team that has, you know, significant costs feeding in, your management team, and then ultimately your board as well. So I feel like it's important for everybody to be on the same page in terms of what the company goals are, obviously, so you can all work towards the same goals. And in that respect, I find it usually quite useful to take the budget numbers, which you set at the beginning of the year, and then distribute those to be the team and individual targets as well. So everyone is aiming towards the same number. I've seen times when, you know, different teams will create their own targets completely independent of the budget. And obviously, you know, the chances of you hitting your budget are going to be pretty slim if the teams are targeting something different. And then internal and external use. So one budget, ideally for both yours. It is fairly common to use 2 different models, because you often maybe want to show something more ambitious for the investors. What I do find with that often though is when you get into the reporting and you're reporting how you perform against your budgets, it causes a lot of confusion internally, because people keep forgetting what budget you're actually talking about. And you have to remember 2 sets of numbers, you know, 2 sets of drivers, 2 reasons for why something was portrayed this way or that way in the different versions. So I personally recommend, as much as possible, just to have one budget that covers everything you need it for internally as well as externally. Okay. We also got quite a few questions on sensitivity and scenario analyses. So once you've built your budget, and that's basically what you'll call your base plan. So that's just the baseline of what you expect to achieve and how you'll achieve it for the year. Once you ideally have maybe like a finance or a finance analyst that can help with this, or just an Excel whiz in general, companies will start doing sensitivity analysis or scenario planning. So really what we're trying to do with this is to understand how variables in your plan can impact your financial goals. So as an example, with sensitivity, you might pick one key driver in your plan, you know, either flex it up, flex it down, and then just see how that flows through your model, and therefore what the impact is on your net P&L and on your cash balances. On the scenario side, you would then think of actually a scenario that could impact multiple variables. So there might be 5 or 6 things that you need to change to reflect a completely alternate scenario, flow all those changes through your model, and then again, see what the net impact is on your P&L and your cash balances. So just as an easy example, let's say you are planning on high customer growth through a refer a friend campaign. So in the sensitivity scenario, you might have thought as a baseline, you were going to get 100 refer friends a month. And then you could put a sensitivity in which says actually what happens if I only get half of that, and you're only changing that one driver, which is the success rate of your refer a friend campaign. So you change that one driver and see what the impact is. On the flip side, with the scenario, well, COVID's our easy example. So what happens in COVID, right? Probably there's like a lot of things in your budget that are changing. So you would change your refer a friend success rates. You could potentially change the pricing that customers are willing to pay, because a lot of people are less able to pay the same amounts that they used to be able to. You'll have existing customers asking for more goodwill or payment holidays, and staffing might look different because you might be hiring less, or putting staff on furlough and things like that. So in that situation, you're changing a bunch of different things to see what the impact is. Cool. So I hope that makes sense. I'm going to jump into management reporting now. So first of all, what is management reporting? So reporting is essentially comparing the difference between what's actually happening in the business throughout the year and comparing that to a baseline, which is typically your budget, and provide analysis that is actually useful for the company to then make future decisions off of that. So why do we do this? First of all, it is just to compare your performance to your goals, see where you are off or on track ideally. And what I find typically is most useful is then really to have a report that triggers management discussion on if any changes are needed. So, deviation from performance can be positive or negative, but really the question is, knowing that, what do you want to do about it? So again, where do we start? So first of all, you need to decide what baseline you want to be comparing your actual performance against. So typically it would be a budget, or if you are forecasting quarterly, let's say, maybe every quarter you want to compare your performance against a new forecast, because it could be a situation where your budget is so out of date that it's not applicable, and it's more meaningful to compare it to a forecast, and that's totally fine. You will typically then have your financial reporting and variance analysis, which is probably you'll have your P&L, what your P&L budget was, how your P&L is actually coming in, your cash balance and things like that. Then what management probably is more interested in is any non-financial reporting. So I'll get into this more detail later, but really the key question is, what is important for your management team to know, and therefore how do you report on that? And it's typically done monthly because it just follows the finance accounting cycle where we close the books every month. Ooh. So in terms of the financial reporting and variance analysis, like I said, one of the key things is typically your P&L performance and comparing that to your budget. So again, if you're just starting out as a company or you're just building your P&L performance reports for the first time, you probably will expect some high variances compared to what you actually thought would happen. And the whole point is to learn, where your planning is different to what's actually happening, and take those learnings and make your forecast incrementally better. Once you do have a relatively solid budget process in place, you would typically try to aim for 5 to 10% variance on your P&L, and that would normally be quite good. You're rolling 3 months performance, so it's easy for people to see the trend of what's happening and what's changing of the last few months. Normally, at least internally, you will show your cash balances as well. Again, cash is king, so understanding where your cash is compared to where you thought it would be is always important. And then depending on your business or your industry, there might be things on your balance sheet that are relevant to monitor. So if you have a lot of inventory and physical goods that you have to buy and sell, you might want to monitor your inventory balances so you understand, how much cash is tied up in inventory at any point in time. With your variance analysis, when you're trying to explain what's happened versus where you thought it would be, obviously you want to be thinking about the why. And normally it's useful as well to highlight if something is a temporary or permanent variance. So if you just had a one-time spike in the consultant fee, maybe that's fine. It was a one-time cost, and there's no need to talk about it too much. But if you think that something's going to be a permanent change, maybe you've hired double the number of people that you thought you would, and that headcount will be in your P&L obviously indefinitely. So that's probably something that you want to talk about, because that indicates that you'll probably have a large variance on your staffing costs for the rest of the year at least. In terms of the non-financial, ultimately what you're trying to do is tell the management if the business is doing well or not. So think about any important non-financial metrics that you might have, any funnel metrics that are useful to know, reporting on external factors, and then upcoming opportunities or challenges, any risks that are facing the business. Yeah, so just as an example, some common non-financial metrics that people do report on will include things like your marketing and sales funnel. So that maybe the number of leads and their conversion rates, and then how that ties ultimately into the number of customers that you have. And then in terms of customer metrics, things like NPS, activation, engagement rates, any churn, or upsell, cross-sell, again, depending on what your business is. Other common metrics just to reflect the business might be things around your headcount numbers. Yeah. And then employee NPS. If you do have any results from internal engagement surveys, or product and tech updates as well, like what does a product roadmap look like? Are things on schedule? Any kind of commentary on that again, ultimately is telling the management team, is the business healthy? Is it doing well? Are there areas to flag where we think there might be genuine risks to the business? Cool. Okay, so just to summarize, ultimately, the end goal of the management report, like I said, is to know if the company is performing against plan. Again, because I believe in alignment across the business, I think having open communications with your various team leads or various people that contribute to performance is really important. So if someone is, let's say the marketing team is not bringing in the number of leads that you expect them to have, like that should be data that you all know about as it happens before it goes into a management report. And then working with them to really understand why that's happening. Because obviously you don't want to be in a situation where you're reporting on something to management or to the board and that team doesn't know what you've been saying. So it's good to avoid that. And ultimately it's always explaining the why, like why has something happened? Why is something deviating? And then so what? Like, so what do you do about it? Just some quick tactical elements. So in terms of how to report, I guess first and foremost, like pretty basic in terms of presentation understanding, but how does your management team or how does your board absorb the information? So do you want tables of numbers? Do you want visuals? Do you want slides? And if you have the resources internally to set up a job performance, so with the report every month, but having graphs that show what you thought your revenue targets would be and then where they're coming in compared to your budgets, just so it's really easy visualization, and you've got maybe 5, not more than 10 graphs that can be a good dashboard to show where your company is going. And Trevor would have covered this in her data talk last time, but maintaining a record of each month's data just in case is really quite important. As you progress, maybe your data changes or the way you calculate something is changing, and that's okay, but being able to go back and understand what you reported and how you got to that number at that point in time is always useful just in case. So onto fundraising. And again, this is going to be coming from quite a finance specific view just because of the nature of the topics. But what are investors looking for from finance? What we're finding more and more is that investors really want a finance person that can discuss the numbers relative to the business objectives. So someone who can understand the business, the product, where they fit in the market, and then really just using the numbers to support the value proposition of the business. But again, because of just various incidents that happen, and probably some of you have read about what's happened with Wirecard as an example, they do also look to the finance person to be good with the execution of the finance function and financial controls. So just as a quick example, a good financial control typically is around payments. So you don't want just one person to have access to the bank account and be able to send any amount of money to anyone without someone else reviewing that or approving that. So your bank account should have a control in it that says, one person sets up the payment, a second person goes in to approve to make sure it's correct and going to the right bank account. So things like that are still relatively important to certain investors. Again, maybe depending what stage of company you're at. Cool. So I just have some suggested metrics here that might, differ again, depending what business you're in or what part of the life cycle stage you are. But ultimately, a lot of the time, the investors are interested in metrics that really explain to them how the business is going. And they, it's important to know they don't necessarily expect any projected numbers around these to come true exactly. It's really more about understanding how you thought about the number getting put together. What was the data points that you used to come up with any of your projections? and are you recognizing anything that you don't know? So, and so I'm not covering anything here around the non-financial bits. Like obviously your investors will talk to your various teams around this go-to-market plans and the product roadmap and stuff like that. But a lot of these numbers will come, your customer unit economics is essentially a profit and loss statement just for a single individual customer. So, what is the amount of money you make from one customer and what are the costs that you incur to service that one customer? And so these are the kinds of things that the investors will expect to know about. And just quickly, in terms of rough timelines, probably some of you have gone through some investment rounds. So these are pretty rough averages, to be clear. But first of all, you'll probably start off with an investor roadshow. You reach out to a whole bunch of VCs. I think 4 weeks is a relatively short roadshow. And again, depending on the market and what's going on, this could really take up to 6 months, a year. So there is a massive variable in terms of how long that roadshow timeline is. Once you do get past that and you get some term sheets, typically it might take 1 or 2 weeks to negotiate some of the terms back and forth. And that's the point at which lawyers tend to come in, review the term sheets on your behalf, again, with your VC lawyers, and then hopefully get that signed within 2 weeks at least. After you've signed the term sheets, there's usually more serious due diligence. So the VCs will come in with their lawyers, potentially with some finance tech experts. They'll come in and talk to the people, like the different team leads around your business, to dig in deeper to various things. And this is the part where you also will end up needing to disclose anything, like if you've got legal cases going on, large fraud, or just anything that basically the investors should know about before they really sign the deal. And just to be really clear, it's pretty normal for lots of small companies to have some skeleton in the closet. So ultimately what they're looking for is just to make sure that you're not, the skeleton's not bigger than the average skeleton, I guess. And typically that might take 3 to 8 weeks, just depending how many questions they ask and how fast both parties move in providing the information. But once that's done, then yeah, normally you could close the deal in 1 to 2 weeks. And this is really where there's just a lot of paperwork. Existing shareholders will need to sign a bunch of documents. So the more shareholders you have, like potentially lots of angels, for example, then it might take a bit longer to get all the paperwork signed. Once everything's signed, the investors will send the money to your bank and you can consider the deal closed. It's a great feeling. Ooh. Yeah. So, and that is the end. I think I've just made it in time for Mark's session.
Thank you so much, Julie. I'm not going to hold you up any longer. And Mark, over to you. I'm just going to disappear in thin air again. But thanks so much, Julie. This has been incredible. So many great tips and so many things to take away.
Thank you. I hope it's useful.
So I'm just going to go through the questions and answer those, if that's all right, in terms of what is best practice. So if you do have any questions, please just drop them in the Q&A box. Interesting to see a few come through. Luckily, I had time to Google some of them to understand what was being asked. So there's some interesting ones here. So which one to this one? So how do you manage budgets? How to manage budgets and forecast after an expected crisis? Obviously, we've all gone through COVID-19. I think the way that I have approached it is that when there is an event that causes a substantial change to the goals of the company, then there is a reason for rebudgeting. So it's resetting the goals, the targets for the company as a whole, rather than just changing where you think you're going to be able to get to according to the plan. So for us personally, we did a full rebudget at the end of Q1 so that we know where the company is going to be following a substantial change in the circumstance, not just of the company, but at a whole macroeconomic level. And then in terms of forecasting, that just stays the same. You're reforecasting on a monthly basis based on the events that have happened in that shorter time period. I think it's fair to say that everyone has had to change their plans, but to change the budget, to change the targets, to change where you think you're going to get to by the end of the year, as Julie said, that requires stakeholder buy-in So it is not just up to the company. You have to have the angels, the investors, buy into that change of plan as well, and to go through the right process of getting sign-off by the board and by the directors to make sure that everyone is aligned with that new plan. This is a good one. What tools have you found are best for reporting, creating dashboards, etc.? I am going to be horrible to everyone and say, unfortunately, for me, it's still Excel or Google Sheets. There are plenty of apps that link in with lots of reporting, ERPs, Xero, and I think that they are fine for simple companies where there are only single entities. I have never come across one that can deal well with multiple entities, multiple currencies, and give me the flexibility that I want to be able to do, either because I'm in a company that is slightly complex, or I'm in a company that changes its minds about how we want to report on a monthly basis. So for me, it is still Excel, and not having the skills to be able to manipulate data in Excel, I think will hamstring you and being able to present the data in a way that you want to be able to show it to internal and external sources. What's the main challenge involving the financial statements of a fast-growing startup company? So I think there's two elements to this. There's the data for financial statements, the management reports, the annual financial statements, which is a review of what has happened. And then there's the issues of creating data for budgets, which are things that are going to happen. So in terms of the reports, reporting on data that has happened, reporting on time periods that have happened, and the financial statements, the management accounts, it's getting access to the data and having the resources to be able to deal with the data so that you can show it in the right way, in the way that you want to be able to show it. So you need to be able to drill in to the data so that you can present it in the right way, show that the reason for changes from variances from where you were expecting it to be have changed and what's caused those changes. If you do not know what is happening in the business, that's very difficult. So this is where an external accountant is going to struggle, because they don't have the knowledge of the business to be able to explain those things. So it's really having those tools in-house to be able to explain variances. And then in terms of future looking, one of the main challenges of creating the budgets, in every single budget and every single forecast, there are assumptions that need to be made. So it is who is going to bear the risk of creating those assumptions. Is it going to fall on finance's hands? Is it going to fall on the COO's hands? Is it the founder? I think one thing that is difficult here again is having this outsourced completely. So is your outsourced finance professional going to be able to understand the business, to be able to understand the drivers of what is going to change? So those are the two different elements of where it is difficult in a fast-growing business. It's the resources to be able to understand the data you've got, and in terms of forward-looking, the assumptions that you need to make. They're not simple equations. There's a lot of estimations that need to go into it. Do you have a preference between deterministic and stochastic forecasts? So this is a good question. I didn't have a clue what this meant. I had to Google this. From my side, it is important to have deterministic view of what's going to happen. It's the known knowns that you can deal with when you're creating your forecasts. So I would always deal with known variations that you can plug into a driver spreadsheet and make some variations according to those changes. I think the one caveat I would say to that is that if there isn't a really important line item in your financial statements, for example, if revenue is really dependent on certain things, if it is low value, high volume, that can vary significantly, then there might need to be some more modeling that goes into it. But I think in terms of the general creation of a financial model, I would always take the deterministic approach. As the company grows, what do you recommend the path for who touches the different parts of reporting and who is most deeply involved? Are there trade-offs if too many people are involved versus if only the CFO and the founder do the work? So I personally think that it's really important that as many people are not necessarily involved in the creation of the reporting, but involved in the understanding of the reporting as possible. I don't think that this should be a report that is only given to the founders, only given to the board. I think the whole company really needs to understand where the company is, where the company is going. I think it's probably that fine line between just having the financial statements as a report and it's gathered dust somewhere, or do you use it to be able to see where the company is going wrong, where it's going well, use it to be able to change tack. And this is where the whole point of reforecasting comes from. What do you need to do to be able to get back to your original budget? Is it increasing revenue? Is it reducing costs? Is it a combination of the two? So I think as the company grows, it is all about getting more and more people involved in the understanding of the documents. And then in terms of the creation of the documents, I think you would start off with a limited number of people, whether that's the finance person or the finance person, the CEO, or the person responsible for finance and the CEO. And as you get bigger and as the budget holders become more accomplished and understand more about what it's going to cost to be able to scale out the business, then there is a requirement to push those questions out to the business. And that's when it starts to get a little harder. It's not just a case of a single spreadsheet where one or two people have access to be able to change and vary it, and then you deliver it as a fait accompli to the company and say you need to deliver that. There has to be a bit of give and take to the whole company to gather information and then get buy-in from the whole company to be able to deliver it. So at what stage do you really start to think about the controls environment from a finance perspective? And do you have any recommendations on where to start in building out your risk and controls matrix? I think this is driven mainly by the investors. In every situation that I've come into a business, it's been after a Series A. And from the investors' side, it is a case of, we are giving you a large check. We want to make sure that that money isn't just going to run away. We want to make sure that we're putting it to good use. So I think it's partly going to be driven by the investors. Are they requiring that a finance person is put in place? Are they requiring that an audit is put in place? And partly it's going to be around how risky the risk profile of the business itself. If you are in a well-regulated industry, it's likely that your need for a risk register and the need to talk about risks at internal and external meetings is going to be sooner than those where the regulation isn't so extreme. So that's a bit of a woolly answer, but for example, myself, we're post-Series B. Risk profile, risk register is something that we talk about, and we have a session in the board meeting where we can discuss major risks, but we haven't gone to the minutiae detail of creating a full risk register. And I think that, again, that will be dependent on the investors. How do you gather insights from what you'd originally forecast versus what you'd achieved? Is it a case of analysing forecast versus actual and updating your forecast on a monthly basis based on those findings? So what can you do with the data that you get? The important piece from the reporting side is, what should you, based on the historical information you've got, how should you change your forward-looking information so that you can see where you're going to be compared to budget, and if there are changes that you need to make. I think that's quite a dry advice. better than that, the insights you can gain from where you think you're going to be, what you need to do, is what you then operationalize from it. So you take your information and then you deliver that as a business. You know that you need to increase revenue. Do you need to go out and increase sales heads? You know you need to decrease costs. What elements do you need to tackle to be able to increase your profits? You've seen that you're going to be cash out in 7 months. You haven't started looking at fundraising yet. Those are the sorts of insights that they should really start to look at answering. I think those are all the questions that are in the chat. Are there any questions that you'd like me to answer live? Any horror stories or funny stories about mishaps with this stuff?
I think that's both for Julie and you, Mark.
I mean, the person responsible for finance is never going to come out of it smelling of roses. If there are mishaps with this stuff, it's normally the sort of stuff that starts to appear on the news, and the auditors get a bad bashing for not picking up on this stuff. I mean, again, what I'd say is say what Julie said. The only thing certain about this stuff is you're never going to get it 100% right. If people expect the numbers to be bang on where you say they're going to be, then they're not living in reality. I think a piece of advice that I would give related to this is be aware that investors sit themselves with a healthy dose of reality. So if you are showing a financial forecast where you go from nothing to £100 million of revenue in 2 years, you know, I think you should take a hard look at the numbers to make sure that you can prove that actually that's realistic. I think a healthy dose of realism is a good approach to take. Obviously, you need to balance that with making the company look appealing enough to be able to invest in. But I think at the earlier stages, the opportunity to invest comes from the product and the founders rather than the model in itself.
I was going to say probably a relatively common horror story, as well as, you know, again, when you're in early stages, you might also be the only finance person, or, you know, the only ops person standing in for finance. So when you're building something like a model, try to keep it as simple as you can in terms of the inputs that you put in and the calculations and the outputs, because it's so easy to make a mistake. And it happens all the time with finance analysts. Like, you know, there'll be so much going on in the model as you start to mature, or you know, the CEO wants to see, what if this happens, or what if you build that in, and it can't be that hard to build it, just do it. And so you'll start building more and more, and because it's all in these formulas, it gets harder to figure out if something was missed, or you could have a typo and it could just change the model completely. So again, back to just that sense check point, like, it's fine to have a couple of mistakes in there, because that is just human nature. And if you make a couple of small mistakes here and there, like, investors are usually pretty forgiving about that, because again, they all know they're relatively realistic and they see this all the time. But even if there's no like major Excel experts in there, or Google Sheets experts, I think getting as many people to look at it and help sense check. So again, going back, like, what are the key drivers and are they realistic? And then just, you know, sense checking the output, like your final P&L numbers, do they make sense relative to what you're throwing in? And the more eyes you can get to at least help sense check will help catch if there are any potential errors. Because I guess the worst thing to happen is if you really had a massive error that projected a really different revenue due to some calculation error and that was the basis of an investment, and then it turned out that that formula was incorrect. That's probably where you will run into problems if it's really, really material, like, you know, like tens of millions of pounds different, for example. But yeah, so just to avoid that, pull in as many people as you can, get them to help sense check and be a second pair of eyes. Yeah.
I definitely agree on the simplicity point. You are building these models and these financial statements for the company and also for other people to take a look at. Be prepared for investors to want to pull the reports apart. So if you have to talk around overly complicated formula, it does start to get very complicated.
We've got another amazing question from Kelly Gold. which is, do you usually see the COO role be the voice of reason versus the wild visionary CEO? Which I guess, like we all know, when it comes to numbers, and is that something that happens a lot? And is there a smart way to approach such internal dynamics when it comes to forecasting and scenario planning, growth projections, etc.?
A simple
I would
answer,
say that
yes.
it doesn't always have to be the way, but I would suggest that whoever is in charge of the finance needs to be the yin to the CEO's yang, and so if they are that wild visionary who is saying that they're going to have £100 million of revenue after having nothing this year, then yes, to have that healthy dose of realism should be used to balance that out.
So one of the common questions I've gotten from the board as well as investors is also like, as a finance person, do you believe in these numbers? So as an ops person and a finance person, typically we're sort of more naturally conservative as it is. But ultimately, if you're putting numbers in front of people that you cannot believe in, then that's probably telling you that something's wrong, and you need to be able to speak up and articulate that. And I mean, investors will take the numbers and they'll round them down, they'll round them up for their own analyses. So they will do that. But ultimately, they want to know what the company believes. And if what you're putting forward is not believable, then like they won't invest anyways. Because again, the model is just an output of what you're planning for the company, and it's really to show like the robustness of how you think about things. So they need to believe in how your thought process works. Yeah.
And in terms of best practices for how to approach those conversations, I'm not sure if there is really a best practice, but it's being able to drill down into each line item, each of the drivers, each of the main drivers that go into those models, and make sure that you can cover as many bases as possible. So if you are forecasting a lot of growth, does the model have the sales team in place to be able to have that? So if you are optimistic on a certain number, make sure that you have the same optimism on the costs to deliver on that.
Makes sense. And I mean, no more questions are coming in, but I have one more for you. I am the operations person without the financial qualification, looking after financial planning, looking after everything that should be your jobs essentially. And I know that ultimately we will need to hire a finance team. So what can I do right at this point so that when I hire that first person, probably way down the line, they don't hate me, they don't scream at me for doing something really stupid when it comes to putting together a financial plan, or any other mistakes that you have come across when you take over from operations people who really wanted to make it right and really try their best, but there was just one or two things that wasn't quite what you wanted.
I think I laugh at myself when I look back at the previous year's version of the model that I created. So I think it's really tough when you're working in a fast-growing environment to expect that either yourself or the person doing the role before you got it exactly right. So like from my side, actually the most important thing is that you haven't tried to hide things on purpose. Just be as open as possible so that you know where the skeletons are. If there are things hidden away, that's the worst thing to hide, to find as someone coming in. As a finance person coming in, I've always ripped everything up that was in place and put in my own systems, my own way of being able to show the data, my own way of being able to forecast the data. I've been lucky enough to be able to go into a company at an early enough stage where that hasn't caused too many issues. But I wouldn't worry that you need to have everything in place and correct and right when you're dealing with the finances now, because the company will change as you expand. I think it's right to expect those sorts of changes to occur.
Yeah, I'd probably just add, in terms of financial modeling, if you're putting together the model, it might be helpful to list out the assumptions in there. just to document like what made you think certain things, or what data points did you use, if there's like a market paper that you use to calculate an average or whatever it is. So at least that way when the new person comes in, they might completely rebuild it. That's just what finance people do, but at least they have your thought process, that they can understand why you did things the way that you did them, and that at least at the very least gives them context on what was happening in the company at that point in time as well.
That's a really great answer, and I just want to repeat something that we had from the last session. We had a guest. He's a financial controller at Stajby, Abby Galade, and she said something that I still carry. I still haven't done it, but she said, when you go through things, and I hopefully will repeat it in the right way. She said, you're not going to fix everything as you go. So at least have a list, so that whenever the finance team is in place and they're ready to take over from you, at least have a list of all the things that you really wanted to do, but didn't know how to, or didn't get around to it, and maybe prioritize it as well. So I really like that advice, and I think it's relevant to financial planning, fundraising, capturing data, to basically all the facets of finance. Great. Well, everyone's been super quiet. I guess it's dinner time. Julie, Mark, thank you so much for running the session. It has been incredibly valuable. I think so many very, very actionable points to take away. And we also have recorded the session, and we will be uploading it on YouTube. For everyone who has joined us this evening, thank you so much. Really, really grateful that you chose to spend your evening with us, that you asked all the questions. And there is a poll that I just launched for whoever is still here. If you could just leave us some feedback, that would be great. If you have anything more to say, we are at hello@operationsnation.com. We will have more events coming, and the way that you can hear about them, you can follow us on LinkedIn, on Eventbrite. You can subscribe on our mailing list on operationsnation.com. Yeah, thank you so much. See you next time, and thanks once again, Julie and Mark, for leading this, for sharing your best practices and knowledge. This has been really, really incredible. Thank you.
Thank you. Good night, everybody.